As we look for Salesforce, Okta, Crowdstrike, and NetApp here. So Salesforce going to hit first. Let's get straight into it, guys. Here we go. Over the next 30 minutes, we're going to get through a lot. Salesforce closed down 2%, by the way, at $256. And right now trading around 260. So a little bit of a net positive move after some good chop there. The outlook seems a little light compared to the estimates of analysts surveyed by Bloomberg. Salesforce sees revenue up to $9.36 billion, whereas the average was $9.4. Note I said up to, so their next quarter, third quarter revenue estimate is between $931, $936. That's a little bit shy. The trailing, though, was good. Second quarter revenues of $9.33 billion. Beat 9.23, and you can't complain, I guess, if you beat one, miss one. Is it a neutral? Caroline, they beat the trailing earnings too, so it looks like just the forward look not quite as juicy as the trailing numbers.
Yeah, I'm just taking a look here at how the market's receiving this. As you said, shares were down about 2%, but looks like it's getting a little bit of a pop right now. You mentioned that the next quarter or current quarter guidance could be seen as a little light, but they did maintain their full year 2025 revenue guidance of $37.7 to $38 billion. That's up about 8 to 9% year over year. They also maintain their full year 2025 subscription revenue. In terms of the actual, the trailing number, second quarter revenue of $9.33 billion, that was up 8% year over year and slightly ahead of estimates, actually a little bit ahead of estimates. The estimate was for $9.23 billion. In terms of current remaining performance obligation, that's a key metric for the sales forces of the world. That was expected to be about $26.3 billion, and I'm taking a look here, and it looks like it was $26.5 billion. So a little bit of a beat there as well, up 10% year over year, up 11% in constant currency. And then in terms of adjusted EPS, $2.56, that easily topped what analysts were looking for $2.35. So a beat on both the top and bottom line. Full year guidance maintained, so no boost there. I think what's helping Salesforce is that it's gone a whole lot of nowhere this year. Shares were down about 2% year to date heading into this report. So, expectations certainly weren't that high, but this is all going to be about commentary about monetizing AI, and that's really what we'll be looking for on the earnings call here. So, a pretty solid report here, at least from what I can see.
Yeah, not bad. Certainly could have gone worse. The overall slowing of the top line is obviously expected. Knew that coming in, but it still is a pretty big deal to see Salesforce sub 10% total sales, 9.3, what they hit, lowest ever. But market knew that was coming, Kevin, right?
It did, but actually the bright spot in this report, which is another reason why I think the stock's actually getting a little bit of a boost, is the operating margin and gross margin guidance. They actually did improve that. So even though they're seeing pretty much flat revenue, when I say flat, they did not adjust their revenue guidance moving forward. They did adjust their profitability metrics, and that has been the theme from last earnings. They have put in a lot of initiatives in and be able to reduce expenses here. And if they can reduce expenses and revenue still stays a little bit light, or we have single-digit growth, that's actually going to improve profitability. That's going to improve the bottom line number there. And we already know that they have a pretty robust share buyback program that's actually taking place here. So it's a decent report, a little bit light on the guide, but when you're looking at the areas that it had to hit, expense management has been a key one that investors wanted them to focus on, and it looks like that's what they're doing. I
mean, that is the critical point that fits with the sales slowdown, is that, okay, just wring more out then. If you're not going to be booming and going stratospheric with the new big customers, then at least get as much as you can and make the business more efficient. So they've been in this process for a while, but the market hasn't quite rewarded them the same way as their pure growth days. But I think the clearer this picture becomes, then the more likely maybe that they will reward it, Caroline, because it's, there's no surprise in this from the sales side. It's Kevin's point. If they can squeeze more out of the lemon, then all right.
Yeah, and I think that could be why analysts are largely bullish on this name as well. Obviously, the fact that it's underperformed this year. What S&P's up, something like 18%, and Salesforce is down, now about 1.5% year to date. But I've seen analysts talk about that it's really one of the few software companies that can. Is well positioned to capitalize on AI monetization and see top line growth from that. So I think commentary is going to be important for Salesforce. We'll see if Benioff can impress and if we can see further gains other than what we're seeing, because right now it's pretty modest.
Yeah, also side point there, as you mentioned, leadership, the CFO is also going to be stepping down. That'll be a process, though, a transition period that's going to start right now. Amy Weaver stepping down as the Salesforce CFO. Let's talk CrowdStrike. Shares are trying to rally here in the aftermarket. Their fiscal year revenue outlook, they say, could reach $3.9 billion. They had previously guided for a minimum of 3.98 with the possible extension above $4 billion for the fiscal year. So they dropped that down now by about 100 million. So that seems like, pretty much the impact, I guess. Lowering down your fiscal year when you're heading into the third quarter, obviously a little bit of disappointment there, but considering what could have been, that doesn't seem like a guidance revision, KG, that screams customers running out the door.
No, and they actually do call this out, and this is exactly what they needed to do. They wanted to be able to identify at least a number in order to make their customers or try to satisfy their customers. It's not for the lack of volume flow or new contracts being brought into the market or being brought into the company. It's the fact that they're going to give out incentives in order to retain those customers or try to make them whole, if you will, because of that outage. And they explicitly call that out. This is one way that they could have done this. They could have taken a non-cash charge against the company, right? And then basically over time, as they do have these incidents come up because of legal issues or what have you, they could utilize that non-cash charge and kind of have it as a one-time issue, or they could adjust the guidance moving forward. They did the adjustment when it comes to guidance. Now, here's the thing. They better hope that they hit that number and they actually are better than that $100 million slide, because if they continue to have issues in a quarter-over-quarter basis, continue to reduce their guidance because this is the method how they want to really track the impact from July, that can be a problem. But at least they made an acknowledgement that the incentives that they're going to have to provide them is the real driver for the lack of revenue growth, and not the fact that volume has been light or they're not able to bring on new contracts. Very key difference there.
Tough one to know how the market's going to deal with this, because some of their profit and income estimates also are a little bit off. Their trailing second quarter income actually was pretty good. Operating income 227 and change million versus the 206 million expectation, but then their earnings for next quarter as high as 81 cents. Street was looking for 96. So this is definitely costing them a little bit here, Caroline, in a way that, all right, damage control costs money, so fine. Maybe they get a pass for that, but it makes it kind of hard to figure out if the market's, we'll just find out, I guess, if the market's ready to give them a pass.
And this one, I think that the earnings call is going to be so key, because it's really the first time that they're facing analysts in terms of having to answer some of those tough questions about the fallout. The initial impact, to me, doesn't seem all that bad, considering Delta's blaming, CrowdStrike and Microsoft for some $500 million in damages. So obviously they have a lot of lawsuits up their sleeve as well. So the chaos certainly isn't over. I have seen analysts point out, they're largely bullish, but I have seen analysts point out the fact that this happened obviously at the end of the quarter, only 2 weeks left, and it takes quite a long time, from what I understand, for companies to actually change up their cybersecurity offerings. So there could be a lag. Doesn't seem like there's going to be all that much of an impact based on the guidance that was given, but I do think that's important to note. And it is important to note it was still a beat on both the top and bottom line when you take a look at last quarter. But I think commentary is going to be, very key for this one. It looks like right now the market is pretty pleased with the results. It was lower today and heading into this report and then pairing some of those losses. But we'll see after the call, based on what the team has to say.
Okay, good point. Going to be a lot in that call, I think, for sure. KG, if you got a last thought on it, welcome to add it, or we can talk Okta, where shares are down. Go ahead.
Yeah, I would say, I wouldn't be too concerned about that margin or that bottom line adjustment, Oliver. Once again, they have a subscription model and they have a pricing model. So as they raise up prices, it drives top line, and then it also expands margins out. And so if they're taking a hit because of the incentives, then rightfully so, we should see almost a one-for-one adjustment when it comes to margins. I don't think that should be a concern.
Okay. Also, right, it's a bridge to get to the other side. When you've got recurring customers, as long as you keep them in, it's going to pay for itself over time. So the retention is what's crucial here. An expected kind of hit to some of the outlook, fine. So shares doing all right here. The only one that's down so far is Okta, which of course kind of has a penchant for slippage over the last couple of years, but still had regained the good graces of the market by the first quarter when they had a big rally back, one of the biggest in a while. So given some of that up here as the shares finished the session at $96, we're dropping right now closer to 90, which does put us in kind of a downtrend for Okta now from the highs. However, it wasn't awful in terms of just the beats and misses. The report for the bottom line did come in quite a bit ahead of the estimates, 72 cents. Street was looking for 61 cents. They did 31 a year ago, so their adjusted earnings, and they are adjusted, are moving in the right direction. A free cash flow at 78 million too. Pretty big beat compared to the estimate, closer to 30, and a decent climb. Kind of a volatile number. They're still spending a good bit on research and R&D, but it looks like they're making progress. I mean, a lot of these things do look like progress to me, Caroline, but the market not really satisfied right now.
Yeah, it doesn't seem to be the case. I mean, it was up about 6% year to date heading into this report, so it was, pretty modest gains compared to the overall market. But you mentioned the bottom line beat, easy beat there. In terms of top line, revenue did increase 16% year over year. Subscription revenue was a 17% increase for year over year. Sequential declines, though, because those numbers were up about 19 and 20% when they last reported. Subscription backlog was an increase of 16%. The subscription backlog expected to be recognized over the next 12 months was up 13%. That's a CRPO. And then I'm just looking here in terms of financial outlook, because that might be what's weighing on shares for third quarter fiscal 2025. The company expects $648 to $650 million in revenue. That's a growth rate of about 11% year over year, so continued slowdown there. And then for the full year, total revenue of $2.56 billion to $2.57 billion, so that's represent a 13% year-over-year growth rate. Just taking a look at what they offered in May, it was 2.53 to 2.54, so they did raise that a little bit. Previously, they were expecting a 12% year-over-year growth, so raise that a little bit. Doesn't seem to be rewarded, though, for that full-year boost, if you will.
Okay. Yeah, it's just kind of like it's in the doghouse still. Analysts don't love it. There's actually more analysts that say to hold it than to buy it, which is kind of a rarity. KG, you got that?
Yeah, I think it's the deceleration of the ARPU, or remaining performance obligations. For the quarter, they had that at around 16% year over year. But when you're looking at their guidance, they're looking for next quarter for that to come in at 9%. So that deceleration of remaining performance obligations, which is the expected realized revenue that they could see within a 12-month period, is decelerating. So even though their guidance looks really decent, that ARPU number actually missing probably is signifying that their backlog is getting worked through, and they're not replenishing that backlog, which is a sign of near-term slowing. And that might be a reason why the stock is sliding just a little bit on those news, because the rest of the numbers look really good. It just seems like their backlog is kind of flushing out here, and they're just not able to refill that bucket. And you really want to actually see that bucket being refilled if you are a software player or a cybersecurity player.
Okay. Well said. Good eyes. All right. Well, look, I mean, it's just a lot of these are never going to really get back to their heyday. I think that's kind of where we're at. That's a fact. And now that the AI stuff is adding a little bit of disruptive element, like we've talked about before, it's not obviously positive for a lot of these companies. now that you can use AI to create pretty powerful programs without a massive team of people. So, not saying that that's like what's going on here, but the idea is that at this point, we know their sales growth is peaked for almost everything in the sector. So it's more about who's got the most reliable profit system, and it seems like that still errs more on the side of like Salesforce, even Crowdstrike too, as we just discussed. This is a company that's targeting further slowing as well, down to single digits. So single digits for Salesforce, I think a little bit more palatable than single digits for Okta. We've got NetApp too, the last one kind of on our list here. We only got about a minute, and then we're going to have to jump to get ready for NVIDIA, but the shares are trying to move this afternoon, beat the estimate, $1.56 versus $1.45. Isn't there a little potential strain on their business, KG, as there's a little Ethernet competition, like not exactly a winner-take-all market anymore between this company and Cisco?
Yeah, there's a lot of competition within this space, and they continue to go back and forth. I think it's also about the technology that's being brought to market, and then how they're going to be really integrated with on-premise systems and also potentially data centers. I haven't seen the actual report here. It does look like for the most part they were actually able to beat the street's expectations here when it comes to guidance for Q2, coming in at $1.73 to $1.83. Street was looking for $1.70. Net revenue guidance $1.56 billion to $1.71 billion. Street was looking for $1.63 billion, so that's pretty decent there. And if you're looking for this quarter for Q1, they beat both on the top and bottom line. So this is actually a pretty decent report from the looks of it. It looks like they're also maybe announcing maybe some adjustments when it comes to leadership. That could be another mover for this stock, but a very competitive space when you're looking at the hardware and Ethernet capabilities out there.
Okay. CEO George Kurian, who was here earlier this year, was really talking up the AI connections too, so potentially a winner if you hear it their way. All right. Thanks, guys. Very good stuff. Very much appreciate the help. Caroline Woods and Kevin Green. When we come